You are listening to chartingwealth.com for Friday, the 3rd of February, 2017. Let's jump right into the markets. What's going on? Stocks are a little mixed. The S&P 500 is up 0.07%. The Qs, that is the NASDAQ 100, down 0.10%. Let's jump right in, though, to what's going on the two-day chart on SPY, which is, of course, the Spider's S&P 500 ETF, exchange-traded fund that tracks that entire index. What do we see going on? Well, we have a two-day candle. The latest two-day candle that we have on the charts is a doji. Doji means that it opened and closed at the same spot. Now, it's the first day of the two-day candle. We're waiting for that to close out on the 3rd. But what we see going on is on the 31st, the two-day candle that ended then, and forgive me, it is not the first day of a two-day candle. It is actually the second day. It is a closed candle. So what we had was a hammer. It was basically a red full box with a long down wick, which of course is a signal with all of the down movement, a potential downward movement. What we saw happen in the following candle was a doji, which means it opened and closed in about the same place, and we reversed over on that two-day chart to a negative derivative oscillator, and also the candle ending on the 31st, we saw our PPO, price percent oscillator, bounce off the red signal line. So we have downward momentum showing itself on the S&P 500. Still closed above the weekly trend line, which is still positive. Now, if we zoom into that weekly trend line, take a look just at it, we can see that the weekly chart is moving along, again, tending to head down. We see that the PPO has started a downward slide, so it had done that before, but then, of course, popped back up on the week ending on the 27th. So we'll see how it ends up the week. Don't think there's probably going to be enough movement to pull it all the way over, so it's probably still going to go into another week of upward momentum on the weekly chart. Remember, all things being equal, the markets always tend to move in the direction of the largest chart, which is our weekly chart. But we don't have any trade on the S&P 500 because we don't have a crossover going up on the two-day chart. Is that enough said about the S&P? Believe so. Let's move on to the Qs. The Qs, we are in a couple of trades on the Qs, if you recall, with the weekly crossover on the Qs all the way back on the week beginning the 9th. Well, it ended on that week prior, the 6th, but on the 9th, we had our entry point on the two-day chart. And in fact, we got in on the Qs on that weekly chart at 121.30 on Monday the 9th at 10:30 a.m. Where did the Qs end up during the day? Somewhere around 1. The high on the latest two-day chart was 125.70. So again, not bad. However, don't forget, we actually reached our highest high of 125.92 back on the 27th. Where should you be if you jumped in way back at $121? Well, again, we do see on our two-day chart, it is trending up, although derivative oscillator is losing energy. The PPO is actually kinked over going back up again. If we range out to our weekly chart, we can see that it's still continuing to move up. Those of you who want to stay in, you can sure stay in if you don't think $4 is enough, or $4.50 is enough to earn over such a short period of time. You could sell half your position and keep what's left in the market. But again, we don't want to be too greedy, but again, we don't want to be stupid when we have an uptrending market. But it does appear that it's getting longer in the tooth. On the two-day, when you look at the weekly, still looks nice and clean. Green open box candles, derivative oscillators gaining energy, and the PPOs continuing to head up. So up to you. It's always the most difficult when you have uptrending charts, figuring out when to get out. So just be careful. And you can always sell part of your position and enjoy those gains. We also had a crossover back on the two-day chart on the, on the 2-hour chart. We had a crossover back on the 23rd. If we look at the 2-hour chart, we can see when that initial crossover occurred. going up. That was on the afternoon, actually, of the 24th. We had that crossover and a jumping in point. Then the market trudged along, crossed back over, going down on the morning of the 30th, and has since recovered and started moving up again. Although, like we said, we are getting long in the tooth on the Qs. So just be careful. Remember where the weekly is. Remember where the 2-day is. Still above the 2-day trend line, but be careful. Once you see these moves and you realize the time of year we're in, if you all have studied the Stock Trader's Almanac, you of course know what Januaries after an election in a post-election year can be like. So be cognizant of that. Be careful. We made it through January, now into early February. You know what February's early winter can be like. So be careful. Be cognizant. All right, we're going to range back out to our 2-day chart. We're going to move on this time to bonds, TLT, which is our 20-year Treasury bond fund on the 2-day chart. Of course, it has been going down. We're still in a confirmed up move on that 2-day chart, but we do see that the price percent oscillator is getting very close to the red line, crossing over, going down, and in fact, the derivative oscillator is already in negative territory. If we take a look at where the weekly is trying to cross. It may end the week crossing over, going up. Has not ended the week yet. Friday is the last day. We shall see. Derivative oscillator continues to gain upward momentum, even though price movement does appear down. Our calculations for the derivative oscillator and the PPO are different, and we shall continue to watch those things. We'll have another call. We may move our gold vertical crossover over from going down starting back in about mid-August to going up in early February. That may happen. Hasn't happened yet. With that in mind, we do not have a trade because we've got a couple of different things happening. 2-day chart still in a confirmed up move, weekly charts in a confirmed down move. Remember, we have to have both those charts, the weekly and the 2-day, going in the same direction. Don't have that yet. May have it soon. Now, lastly, and for the record, TLT, bonds are down 0.03%, just barely for the day. Lastly, we're going to go and look at gold. Gold's in a confirmed up move, of course, on the weekly chart. Those who've been paying attention to that, you know that we got into gold at 113.57. Gold closed the day at 115.83, so up about $2.30 since our jumping in point. Feels pretty good, doesn't it? Feels awfully good. So let's shoot down and take a look at the 2-day chart. What's it showing us? Well, it's actually spiked over and is continuing to move up even higher. Although the derivative oscillator, that's the PPO, derivative oscillators continuing to lose energy. So be careful, be cognizant, pay attention to what's going on, and be happy to take your profits in gold over the course of just a few short days. Just over the course of 4 days, it's had that kind of up movement. So don't lose it all in case gold starts jerking down. Now, we're not seeing that. We're seeing that gold on both the weekly and the 2-day is still going up. The only thing that's a little troubling is that the derivative oscillator is going down, but that's a minor issue. The main things are what's happening with the price percent oscillator on the weekly and the 2-day chart. If we look at the 2-hour chart, what do we see going on? Well, of course, there was a crossover back on the afternoon of the 30th at 2 p.m. That, of course, was a jumping in point for those of you who were using just our standard charting techniques. You could have gotten in at 2 p.m. at the opening of 113.68, would have been just a little less than we got in earlier in the morning. And of course, the high that it reached during the day on the 2nd was 116.57. Whoa, that is really, really sweet. So just continue to watch. I could have been up almost $3. That is actually over $3. That is beautiful. So We like to see our charts working. We're always excited about that. If you're excited about what you see on these charts, nothing's magic here and nothing's complicated here. You don't have to have a PhD in economics. You don't have to be a trader on Wall Street. You don't have to have a law degree, an MBA, whatever. You just have to spend 10 minutes with us every day studying these charts, figuring out what it is we figured out and doing it with us. How do you do it? First, you go to chartingwealth.com, you sign up for free for our newsletter. We've not ever asked anybody for a dime. Now, we may have some training courses in the future. We don't have any right now. What are we doing? We're sharing this information with you. The minute you sign up for our newsletter, you will get it either that day or the next day, depending on when you sign up for it. And the minute that we download the next training, the next stock chart trends and training, which we do on a daily basis when the market's open, we'll send that off to you, included with the text that comes in the email that has the video. You'll have in there our How to Read a Stock Chart video, a link to that, 15 minutes of must-have information that tells you what it is we do. We can do that in 15 minutes, folks. It's simple and easy. Next thing that we do is we also send you our layout that we use at freestockcharts.com. That's the screencast that you see every day. The charts you see are there available at freestockcharts.com. We'll send you the layout we use so you can have it on your own. And then lastly, we also include the daily market worksheet. What is that? That is a fill-in-the-blank form. And what you do is, as you listen to our podcast every day, you fill it out. You fill out the direction of the weekly on all four of our charts. That is the S&P 500, the NASDAQ 100, the 20-year bond fund, and gold. You fill out the weekly, you fill out the day, the 2-day, and you fill out the 2-hour or 4-hour. We've really switched over mostly to the 2-hour now. And you make notes, and you will be amazed at how quickly your knowledge is gained by making yourself think and write down what it is you're hearing. It is the best method we have found for you to really accelerate your learning. If you want to learn how this works and how you can have all sorts of choices in life if you get good at this, and that's the if, then it's up to you. You can spend your time watching TV, watching sports, hanging out at a club, drinking beer. You can do whatever you want. It's up to you. But if you want to figure out how the markets work, we're talking 10 minutes a day. What's the most productive thing you can do on a daily basis? 10 minutes with us. 10 minutes reading your Bible, praying, a lot of other productive things you can sure do that would be more productive than this. But when it comes to your financial future, it's one of the most productive things that you can possibly do. So if you care about where your life's going, where your finances are going, and you want to be in control and understand how this stock market works, good, bad, and ugly, because we'll show you how to make money when the markets crash. We got inverse funds that move in the opposite direction, goes up when the market goes down. If you can read a stock chart, you can make money when things are soaring or when things are crashing. That's what we're all about here. We'd love to hear from you. Go sign up for our newsletter, chartingwealth.com. Also, you want to help us out, subscribe to our YouTube channel. Go to iTunes, subscribe to our channel there, say something nice about us. We have a Facebook page. All of them are Charting Wealth. YouTube, Instagram, Twitter, we're there. You're where you are. Let's all move along together. It's great to be with you. God bless from chartingwealth.com.